From News Radio 1190 KX in Portland this morning update. I'm Paul Lindman. Good morning. Get this, 2 years after President Barack Obama vowed to eliminate the danger of financial institutions becoming too big to fail, and we bailed them out, the big five are bigger than ever. That's what Bloomberg's reporting this morning. Let's catch up with David Lynch. He reports on the economy for Bloomberg News. David, the big five, how big are they anyway at this point?
Well, Paul, collectively they hold more than $8.5 trillion, which is equal to more than 56% of the U.S. economy. That's up from about 43% of the economy 5 years ago. So they are bigger today than they were before the crisis.
So is that a good thing? What are the ramifications?
Well, as with many things in Washington, that depends on who you talk to. The bankers say it's necessary because they've got to compete globally with other big banks from Europe and Asia, and they've got global customers that need them to be everywhere and do everything. The administration says they've put in a whole raft of protections and safeguards, so things are in better shape than they were before the crisis. But there's a number of people out there, and not just Occupy Wall Street types on the left, but the heads of 4 or 5 of the regional Federal Reserve banks who say the too big to fail problem is still there. It hasn't been cured. And if one of these big banks got in trouble tomorrow, the government would probably face the same choice they faced in 2008. Bail them out with taxpayer cash or risk an economic collapse.
Did I hear you say if only one has the problem, we'd have to bail them out?
Well, we might. Of course, nobody knows. But the problem is these institutions, the big five range from Goldman Sachs, which has almost $1 trillion in assets just by itself, up to J.P. Morgan, which has $2.3 trillion. Now, again, the bankers will say, hey, it's apples and oranges. We're not the risk takers we were 5 years ago. We've got higher capital and liquidity ratios, so we're in better shape. But these Federal Reserve Bank presidents say the reality is if one of these big guys got in trouble, number one, it probably wouldn't be one of them. They all tend to fly together in formation, so it might be 1 or 2 or 3 of them in trouble, and the government would really be stuck.
David, I thought the Obama administration basically guaranteed new safeguards that would prevent such a thing.
Well, and they're underway, and to be fair, a number of them have been put in place. The banks do have to have much higher capital backstops today. They have to have more liquidity, which means more ready cash available, more ready financing. So they're not as highly leveraged. They're not taking the big risks with borrowed money that they were 5 years ago. And there are new size limits in place that would keep, say, a bank like J.P. Morgan from going out and buying another really big institution. But the problem is sort of the political reality, which is, number one, the regulatory job isn't finished yet, and people on both sides of the issue will tell you, regulators are never going to have perfect foresight. They're never going to be able to see the next crisis coming, only the last one, and that if one of these big guys got in trouble, the choice would be pretty much what it was 5 years ago.
I understand what you told us about the criticism and the response to same, but isn't the bottom line here, if you look at this neutrally, that nothing has really changed in the big bank business approach?
Well, no, I don't think it's fair to say nothing's changed. I think the issue is whether enough has changed, and that's really the crux of the debate. Because the banks are not identical to where they were 5 years ago, and the government is moving toward implementing new powers that would allow them, in theory, to put one of these big institutions through what they call an orderly liquidation process, which is sort of a fancy word for the type of bank restructuring and bankruptcy, if you will, that smaller banks go through all the time. The FDIC does this and has been doing it for decades, and they know how to do it. We didn't have the authority, the government has said, to do it with the big guys before. Now we will, but we just don't have it all buttoned down today.
David Lynch at Bloomberg, thank you. Let's talk again.
Absolutely, Paul.